Tuesday. Zach, how's it going over there in Philadelphia?
Raining and gloomy.
Raining.
Yeah, not the
sorry.
same as over on the left coast.
Yeah, things are good out here. We are starting a new podcast. It's called Finance and Footnotes. And the purpose of this podcast is to dig a little deeper into the financial press and I give you some ideas that can help you improve your outcomes, right? So just some 3 to 4 ideas that I think we're getting asked a lot. I'm a financial planner. Zach is a financial analyst. So we get a lot of questions. We have a lot of clients. So the point is to kind of address those questions. We've got a few here for you today. And I think we'll start with talking a little bit about the recession, maybe a little bit about market valuations. Zach, what are you going to talk about today?
Well, I'm going to talk about where is the recession, perhaps. The recession that everyone has been prognosticating and forecasting for much of the last year has yet to materialize. So I think there's a couple data points that we can point to perhaps illuminate why.
Yes, absolutely. So let's just start off with that. I was reading Barron's magazine, which is really a newspaper, strange as it is. And it's kind of like the kiss of death, right? So I'll pull up on the screen here. It's the leading article. And they say, hey, where's the recession? So their prediction, they're going out on a limb and saying that there won't be a recession in the next 6 months, which is ironic because if we look back 12 months ago, everyone was saying there's going to be a recession, right? So I think
it does seem to be that a lot of the forecasters and Wall Street banks are changing their tunes a little bit. Goldman Sachs kind of changed their prediction of a recession percent chance and lowered it. Now you have Barron's doing the same. LPL Financial, our broker-dealer firm, raised their year-end target a little bit. So it seems to be that folks are changing their tune a little on perhaps the timing or the eventuality of a recession at all.
Yeah, and it seems to me, having watched this stuff for a period of time, coming up on 20 years, whenever Barron's makes a prognostication such as take it to the bank, there won't be a recession this year, it's almost time to get your ear to the ground and say, wait a minute, maybe that's the case. But it's the same idea we had last year when every single person on Wall Street was saying there's going to be a recession 12 or 18 months ago, hard landing, soft landing. And yet, here we are with unemployment where it is. So I think it's interesting to make the point that here's Barron's making this note. And then if we, I'll bring up another slide here for you. And it's just, this actually came from LPL Financial, which, as you just mentioned, is our broker dealer. They've got a great research department. They've got 20,000 advisors and many, many clients. So they put out these great research notes. And last Friday, they put out this note, this leading economic indicators. And it said, there's never been a low like this without a recession on the horizon, which I think is kind of in line with my favorite Mark Twain quote, lies, damned lies, and statistic. There's always a recession on the horizon, right? It's always tomorrow or 10 years from now, there's going to be a recession. So what do you think about that?
Absolutely. And I think there's a kind of a push and pull of two opposing forces right now, where you have the narrative of the market is pretty overwhelmingly positive right now. We're either at the end or nearing the end of the Fed's tightening cycle. Corporate earnings, at least so far this quarter, were not nearly as bad as feared. Unemployment's quite low. The war in Ukraine is tragic, but it does seem like the world has kind of acclimated itself for that to be a protracted, longer-term conflict, and it isn't roiling in markets and causing extended volatility right now. So all of those things, and obviously COVID in the rear view, right? Almost forgot to even mention it. So that's how much it's kind of faded from our memory. So all of those narrative pieces are extremely positive. But then you have the opposing forces of these leading economic indicators that do have a quite good track record of predicting recessions. And they are as low as they've been since the last major recession. And as LPL pointed out, at these levels, really has always predicted a recession. And there's other ones such as the inverted yield curve, which continues to invert further. Another fairly good predictor of recession, not very good at predicting the timing of recession. Generally, those could be 6, 12, 18, or longer months in advance when that yield curve does predict a recession, but pretty good track record of hit rate eventually. So it's a very interesting time in the market. Yeah.
I think just taking a step back, this is something that I put a lot of weight in, and I think you do too. It's sentiment. What are people saying? And I think if we looked back 12 months ago, everyone was saying one thing, and it gave us pause reason to pause. And then, if we look today, there's a bit more discourse, which is good. I think that's positive. If everyone's doing one thing, I think it tends to go the other way. So here we have a kind of a discourse. And I guess the second point I'd mention is that if there is a recession, people are asking, is there a recession? I don't think people are really going to feel it. I think it's going to be a minor, maybe small contraction, right? So people are working, people are making money. I don't think the average person is going to feel a major bump in their finances.
Yeah, and I think we're just in a demographic situation where it supports employment. Companies have been struggling to hire and to fill positions over the last 18 to 24 months, and they're going to be quite reluctant to let those people go that they finally just found to fill that position. So I think companies in general are just going to really try their hardest to not do layoffs. And pockets of the economy where you've already seen some layoffs, in the tech sector, the high growth venture capital funded sector, those types of areas, you are seeing some layoffs, but those companies had significant hiring booms during the pandemic. So we're still above pre-pandemic levels of staffing in those companies. The economy at large, the broader kind of working class economy, you really haven't seen much in the way of layoffs. And I think that that's likely to continue just because of that inertia of having such trouble finding people to fill these positions.
Yeah, and the great Reagan quote from years ago, a definition of a recession is when your neighbor loses his job, and when depression is when you lose your own. So with everyone working, no one's going to feel it. People are spending money. So I think that's the point that I mention to clients a lot is, even if there is one, it's a statistical, point and not one you feel in your pocketbook, I think is a fair analogy.
Right.
So, moving on, I wanted to talk a little bit about valuations, right? So the second point I have for everyone today is people asking me, what's going on with the market? We have had a significant bounce in the last 6 to 8 weeks. Markets are up meaningfully year to date. So I'm going to bring up a chart here. This is actually in the Wall Street Journal this morning, which is a newspaper who claims to be a newspaper, different from the Economist magazine, which claims to be a newspaper as well. I think it's a little weird, Zach, don't you? It's hard being a financial analyst.
It is.
But so I'm bringing up a chart here of the Wall Street Journal and showing the 3 major U.S. indexes. We're talking about the Dow, the S&P 500, and the NASDAQ. And this is about the last 4 months of data, but it's showing us, there's been a significant uptick with a slight, downtrend over the last week, of course, but things look really positive. And I just want to, get a sense of, where we are today. Price to earnings ratios are a little elevated. The markets are certainly up year to date. The Dow is flattish compared to the NASDAQ, which is up significantly. But, things have really improved. And I think if you asked me, 6 weeks ago, what was going to happen, I would have probably said things look pretty positive only because of sentiment. People were so negative 6 weeks ago. If you looked, there was some data, Zach, I know you and I talked about, there was some data from US money managers had their highest cash allocation in over 10 years. It was extremely high cash allocation. They're very, very bearish. And there were reasons for that, but typically it's sentiment. If everyone's doing one thing, there's the door is open for the opposite to occur. That's a contrarian indicator. So I think, where we are right now, there's certainly cause for the market taking a breath. What do you think? What's going to happen for the rest of the year?
Yeah, I read another analyst's blog post the other day. It was actually shared by one of our advisors here with me, and it said in there that we can disagree on a lot of different things, but it's really hard to disagree on valuation, which I totally disagreed with. I think you actually really can disagree on valuation because a lot of valuation is dependent on your forecast for near-term interest rates. And so where do you think interest rates are going to be, 6, 12, 18 months from now? And if those two forecasts are different, if you think that, the interest rate regime is going to be stable at 5+% for the next 2 years, and I think that there's going to be a recession or the Fed's going to have to come in and cut rates and, we're going to find a 2.5%, 3% interest rate, well, then your valuations today look very different. And generally stocks tend to front run these things. So I think what we're seeing in the market right now is the market almost seeing through a recession, even albeit a mild one, and seeing through to lower rates, which would push up the valuation, right? Or the acceptable valuation, which would push up stock prices, especially in the tech sector.
It's a great lead in to my next chart, which is the inverse of the price to equity ratio, right? This is the the earnings yield, right? Which is just, it's the price to earnings ratio in a nutshell. People ask, what is it? And I often say, it's just the number of years it's going to take a company at current earnings to buy back all of its shares, right? It's a mouthful, but it gives you some idea of how powerful earnings are in this equation. What the earnings yield does, of course, is adds in the current interest rate environment to, if interest rates are paying 5%, then obviously they were paying 0% a year ago or 2 years ago. Now it's just more attractive for folks to put their money under the mattress at 5%. So that does tend to lead to lower valuations over time. But the chart shows you that if we just can share this particular earnings yield, it's about the worst it's been in 10 years, right?
Absolutely. Yeah, absolutely. And yeah.
But the point is, the last point I'll make, and I'll hand it over, is like, price to earnings yields, they sound really important in client meetings, but they're not great near-term indicators of stock market performance, correct?
They're essentially useless when it comes to near-term direction prediction, right?
Exactly.
It does give you a pretty good idea of 3 and even 5-year performance from a starting point of valuation. There's a pretty strong correlation between that. So, you would expect a 5-year forward return number to be under the average return of the market from a starting point where we are today. I do also just think that we're in a very distorted time, right? Just coming from COVID with all the stimulus, the fastest interest rate increase regime in history. It's hard to make historical comparisons just because of the distortions that were present in the market. M2 money supply, up 40% in 1 year hasn't happened since I believe the 1930s. So there's just things that have happened in these last 24 to 36 months that are just different. And I think are distorting some of these numbers, including the yield curve, which I do think is perhaps, the inverted yield curve is perhaps not the best indicator this time around. You always get worried when you say this time is different. You always want to, try to take lessons from history. But I do think there are certain things that are actually different this time around. But you made a really good point. When CDs and treasuries and high yield savings accounts are giving you 5+%, there's not a rush to get into the market as there was in prior years of 2017, 2018. Kind of every time we had a little bit of a pullback, it was always bought. The dips were always bought because there was just nowhere else to put your money. You were earning 0%.
You could almost say there is an alternative now.
There is an alternative, absolutely. And yeah, earning 5% on your FDIC insured CD is kind of hard to argue with when there's storm clouds a brewing.
So taking a big step back, those are the 2 points I want to talk about today, right? Everyone's asking me, is there going to be a recession? And what about the market? Where is it going to go? That's a very common theme. We're going to come back to. We're going to talk about sentiment on and off again in this podcast. We're going to talk a lot about these particular ratios because I think they're important. But I want to take a big step back from the 30,000 foot level and just summarize. I believe if there is a recession, it's going to be minor. Most people aren't going to feel it. And the second point is when you're sitting down with your advisor or you're looking at your newspaper and you're looking at these price to earnings ratios, or you see someone on Twitter and they're talking about this earnings yield, it sounds awfully smart, right? It sounds very important. But in the near term, in the midterm, it just doesn't really matter. And I'll just punctuate it with the most important quote that Warren Buffett ever made about valuations. Zach, you want to guess what it is? Or the holding period. The holding period that he says. What's the ideal holding period?
I'll give you the thunder.
The great famous investor Warren Buffett says the ideal holding period is forever. So it's not often prudent to jump in and out of the market based on valuations, depending, no matter what you see out there. So those are the 2 points I want to bring today. Just stay calm. Things look pretty darn good. There's nothing that we can see on the horizon that's going to shake things that much.
Yeah, I tend to agree with that. There's a couple, perhaps, reasons why, we haven't seen this recession that everyone's predicted is coming, and perhaps reasons why it may still be coming. So we'll pull the slide up on the screen for excess household savings. And this goes back to the pandemic, pre-pandemic January of 2019 through February of this year. And you can see that the cumulative excess savings skyrocketed through 2021, which makes perfect sense. Stimulus checks, increased unemployment, less spending on services and entertainment. No one was taking trips, right? So consumers built up this big excess bundle of savings that they have since spent almost all the way down. So yes, there has been no recession yet. Corporate earnings are still strong, employment's still strong, but perhaps that is part of one of the COVID era stimulus, that there was just so much extra cash sloshing around in people's bank accounts, and now they are spending it, which is obviously unsustainable. You can only spend a surplus until it is no longer a surplus. So that is about 10% left of that surplus still to be spent. And the flip side of that, and I really like this chart, if you look at the credit card debt, usually gets paid down in Q1. So this goes back until kind of right after the post-financial crisis, 2011. You kind of see every first quarter, there's a dip when people get their Christmas bonuses and they get their tax returns and they have their New Year's resolutions that we're going to pay down our debt, right? So there's always a dip in the numbers where first quarter credit card debt aggregate across the economy goes down. And that did not happen this year for really the first time since 2011. And I think that just
is this surreal? So this is, I'm looking at this chart here with you for the first time, as everyone else looking at this, and I'm seeing it's published by the New York Federal Reserve Bank, which is a pretty reliable source of data. As we claim to be financial footnotes, we're always very careful about who we bring to you as data. But what do you think? Is this adjusted for inflation? It doesn't look. If you look at a long-term trend over the last 20 years, what do you think?
Yeah, so I think it's more of a behavioral indicator, not necessarily taking it from a historical comparison on the level of it. I think really just looking at it from behaviorally, in that first quarter, you generally see credit card debt get paid off, and you just didn't see it this quarter. It kind of remained flat. So I think just thinking through the implications of that, and coupled with the previous slide where folks are spending down their savings, is that essentially the consumers are funding their pandemic era lifestyles, which I think there was a bit of an uptick in standard of living when it comes to goods and services spend. They're kind of funding that with savings and credit cards at this point, which you're not seeing in corporate earnings. So the corporate earnings are still pretty good, but this could be a leading indicator of an eventual crack in corporate earnings when these methods of funding just run out, when you don't have the surplus anymore, when you really can't put any more on credit cards. You kind of have to say, okay, well, the party's over. We're going to have to belt tighten a little bit and maybe cancel this subscription or not necessarily go out this many times a month. So I do think that this is one of those indicators where you do see a bit of a lead ahead of corporate and ultimately employment numbers. So just something to keep an eye on. Part of the reason why maybe the recession that hasn't happened yet could still be coming.
I think this is a really cool chart, and it's busy, right? There's a lot going on here. To the uninitiated, this is a pretty impressive chart. But I think your point about credit cards, what I'm looking at here is the student loans and the car loans. I'm really surprised to see the car loans. I think we've all heard about how people are spending more and more on their car payments, especially with the interest rates rising. But compared to student loans and car loans, it looks like credit cards have actually remained within a range bound, if you will. So it's while total debt has certainly increased, credit cards are it's kind of more steady over that period, those 20 years. Definitely.
And then the final thing that I wanted to take a look at was, you saw all through last year and even the early part of this year, if you're on Twitter and you're following financial social media, is all of the corollary people, the folks who are constantly updating their 2022 charts, overlaid their 2000 and 2002 and their great financial crisis 2008 charts, and everyone's saying, hey, the bottom is not in yet. This all looks the same. Everything's tracking the same way. And you kind of saw that across a range of different social media accounts. And I think that I was always in the camp that it's not the same thing in any regards, right? Every bear market is different, has different, history doesn't repeat itself, but it does rhyme, right? That doesn't necessarily mean that the bottom is in, but when you kind of look at what happened in 2000, 2002, and 2008, this is a very different situation. So I think that just looking at it from a price performance standpoint, I think we can safely put the corollaries away that this is not that. Either one of those two historical comparisons are not really valid. And I think that this particular situation will play out in its own idiosyncratic way.
Yeah, really interesting. We see these charts all the time, and I think one of the things our job is in general to clients, and hopefully on this podcast, is to try to talk people off the ledge, right? I mean, we are inundated with negative news. I mean, if you're on Twitter, which I know you are, I'm on it a lot because you get a lot of dispersion, voices and inputs, but it's so negative, right? The discourse is so negative, the news is so negative, and I think I saw a statistic, about 9 in 10 articles happen to be negative, and aligns with our um, evolutionary track to pay attention to negative news bits, right, as opposed to positive. So there's just this negative news cycle, and I think it really affects our emotions and our willingness to invest over the long term. And I think our job to clients is to try to share with them the contrarian indicators, things that can remind them that it's okay to invest for the long term and to stay invested and to not listen to what you hear on Twitter, right? To make educated decisions for the long term.
Absolutely. If it bleeds, it leads. So the media powers that be have a vested interest in bringing you the bad news because that generally brings the eyeballs. Now, if there's legitimately bad indicators that we think are out there, we'll certainly bring them to you. But I think that we want to try to present a balanced, nuanced view. And I think that's really the word, is nuance. Is that all of these indicators and conversations are difficult to get across in a tweet or a single single piece of media, because they're complicated and there's nuance and there's pushes and pull of different forces. So I think part of our goal here, I think, is to try to present things that are balanced and can give folks a little different source of information.
Exactly. So with that, I think we can end today's podcast. We'll be back in a week or two with some more important and intelligible ideas. Anything else, Zach, before we go?
Excellent. Looking forward to it.
All right. We'll see you soon.
All right.